to Indianomics. We are taking a rain check on the state of the economy after the festival sales data are in. Some of it is in. I've been speaking with Pranjul Bhandari of HSBC, Sakshi Gupta of HDFC Bank, and Abhishek Upadhyay of ICICI Primary Dealer. Ladies and Abhishek, thank you very much for your patience. Before we wrap up about the economy, we have to look at the currency. Pranjul, what is the sense you're getting? The Reserve Bank has put in all its might to ensure that the dollar doesn't get more expensive than 88.80. The intervention is strong, but does it look like the rupee has some more weakness to tread?
Yeah. Look, I think a lot of the depreciation and correction on a trade-weighted basis has already happened. But right now, it's a very binary decision from here. It's all about whether a trade deal will happen or not. And on the back of that, the range can be extremely wide. My sense is that if we have a trade deal in which the tariff is cut from, say, 50% to 20%, there could be a sharp appreciation of the rupee because so much of correction has already happened. And, we could be looking at like 86.5 or something. But on the other hand, if there is no trade deal and it's December and we're looking at January and there is no clarity, then dollar rupee could go much higher, like much closer to 90. So at this point of time, the band is very high and it's an extremely binary decision. I would say that on the trade deficit front, my sense is that things are looking good right now in the sense that exports have still held on. But come 2026, we could start seeing some softening of the exports because a lot of the exports are on all these exempted sectors and stocks globally are being piled up. So there might not be that much of exports demand globally for electronics and gems and jewelry and all of that next year. So my sense is that there could be pain if the trade deal has not been signed by then.
Okay. What's your current account deficit for the current year itself? Is it still under 1%?
No, it's between 1.2% of GDP.
Okay, thanks for that. Sakshi, what is your assessment of the rupee range?
Well, Latha, I have a slightly different view on the rupee. I think that whether we get a trade deal or not, my 6-month, 12-month forecast on the rupee is that rupee is going to continue to depreciate. There are a couple of reasons for this. I mean, yes, in the near term, a positive, announcement around the trade deal could lead to some rally in the rupee. But I think that this would be an opportunity for the RBI to come in and build up its, book again. They have been intervening very, very aggressively. And if you look at the size of their forward book as well, I mean, we have data, up till September, but that has gone up quite sharply. So I think this would be an opportunity, and therefore I don't see that a positive trade deal will lead to a significant, rally in the rupee, maybe a knee-jerk reaction. From a more longer-term perspective, look, I come back to the fundamental on your export performance and your current account deficit. Plus, you add to that the fact that there's fair bit of concern now around oil prices, right? I mean, although they continue to remain below $70 per barrel, but at the end of the day, the sanctions on Russia also means that the discount or the benefit that we were getting from buying a lot of the Russian oil also starts kind of petering off, right? And third, I think that the market has been concerned about US growth. They've been talking about US central bank cutting rates, but there's a big question mark around that as well now. So I'm not so certain.
So your range would be?
So we are looking at about 88 to 89.50 for the rupee over the next 6 months. And then I think in FY27, I do see the possibility of the rupee be between 89.90.
Okay, fair enough. I agree there are pressures, especially with the global economy, likely to slow down and beset by Chinese excess, Asian excess stocks. But Abhishek, let me move away from the rupee because I wanted to ask you if there is any scope for an OMO purchased by RBI, even if they say duck the rate cut. Does this huge intervention by the Reserve Bank mean that liquidity is dwindling and there are hopes of an OMO?
Well, that's so interestingly, despite the CRR cut branches which have been coming into effect, what we have seen over last roughly 1 month is that core liquidity surplus, which was close to 5 lakh crores, 5 trillion, has come down to around 3.5 lakh crores. So that is the result mainly of a very strong RBI FX market intervention, which has sucked out liquidity from the banking system. Also, seasonally around the festive season, we tend to see currency leakage being on the higher side. So there has been some drag from there. The liquidity situation is still, I would say, comfortable. But if this pace of FX intervention continues, if there is no trade deal, we could see liquidity surplus continue to dwindle over next few weeks. At if there is no FX outflow, core liquidity surplus could end the fiscal year at around the same levels as last year. But a more likely scenario based on current basically situation is that RBI will need to step in with some liquidity injection, whether through the FX swap route or OMOs, and could be sooner rather than later if pressure on rupee continues and RBI intervenes strongly.
Okay, fair point. We don't have time for more, but that quite succinctly sums up, we thought that our twin deficits problem is behind us, but current account deficit is moving above, the 1% mark. And more importantly, the BOP deficit is pinching rather hard, plus the fiscal deficit, which performed very well, may be constrained by much lower tax inflows this year. So chances of the Reserve Bank having to help out the central government with some bond purchases and keeping yields lower is not entirely out of the realm of possibility. Thank you very much, Pranjul Bhandari, who has left us, and Sakshi and Abhishek for a comprehensive view of the economy. I think the positive takeaway is that there is an upside bias to GDP growth, and a 7% handle looks very, very likely for the quarter gone by and for the full year. We wrap up on this edition of India Economist. Thanks for watching.